Thank you, Bill. Thank you, everybody. I really appreciate it. Can everybody see my screen okay?
Yeah, perfect.
Perfect. Love it. Well, thank you. As Bill mentioned, today we're kind of going to get into the product. We only have one product here on the life side at Allianz, so we're going to touch on what makes it unique, right? Why are we going to surpass 200 million in sales this year with just one IUL product? So we're going to touch on that, and then we're going to go into a few case studies to show you guys some real life examples, show you kind of some of the hot things that I'm seeing come across the desk as far as designs go. A couple of those I think you guys will be able to implement into your practice as you review your book of business. You'll be able to find some awesome opportunities throughout the year. So with that being said, I actually had this happen to me the other day. I'm sure most of you guys travel here and there. I was able to go from the main cabin all the way up to first class. And I remember the feeling of that just being like, yes, this was just kind of one of those little victories. I did a little air fist pump and I was like, this is amazing. But what it also did is it kept me saying, I'm going to stay loyal to this airline and I'm going to want to keep coming back because I want to be able to get these upgrades more and more. And Allianz said, well, why do the airlines get to have all the fun? Why do they get to make the Erics of the world do a little fist bump and just say, yes, can't wait to come back and earn more points and keep it going? And so Allianz said, we need to get in on this upgrade program. And that's exactly what they did. Obviously, they're not an airline, but they said, hey, we can take our product and offer automatic upgrades, just like the airlines do. And that's exactly what they did. And Bill kind of touched on this. And I'll take it a step further. So if you submit any policy with Allianz, you are automatically eligible for this program. Any face amount, 100,000 is our minimum, all the way up to 65 million, which is our jumbo. Automatically eligible. Now, if it comes back at a table 2, guess what? That is preferred best. Come back standard, preferred best. You come back preferred, we're issuing that at preferred best. So anywhere from a table 2 to preferred, that is getting issued at preferred best. A standard tobacco, we're issuing that at preferred tobacco. Now what that does, as Bill kind of touched on, yes, you're going to get those COI savings. You're going to get more money in the distribution phase when they turn on that income stream. But the biggest thing we've seen with this, guys, is the placement ratio. When you go through underwriting with your client, as most of you know, can take anywhere from a week all the way up to maybe 60 days on some of those very large cases. And when you sit down with your client after going through that whole process and you say to them, you are a standard health rating, and I've seen this, the client literally almost gets offended. And they say, no, I'm not. I'm actually healthier than that. Give me 6 months, give me a year, I'll get back in shape, I'll stop, Netflix and chilling and all that stuff. I'll get my cholesterol down and I'll come back at a healthier rating. And we all know what that means. That means the sale is done, you're not going to get the business, and they're not going to go through underwriting again. With this program, guys, you are taking that out of the equation. It's now you get to sit across the table from your client and say, you are literally the healthiest you are ever going to be. And the client says, where do I sign? And let's put this thing in force. And so we have seen tremendous volume obviously increase with this program as more people, maybe they say, hey, I like doing whole life, I like doing VUL. But what they're doing is they're submitting it with one carrier and also with Allianz because they know if I come back standard over here, well, guess what? I can actually save my clients a lot of money and probably get the business placed knowing I can go with Allianz because that's coming back at preferred best. Any face amount, automatically eligible. The second you submit an application, it's automatically eligible. As long as it comes back a table 2 or better, you are getting your client a preferred best health rating. Now, Bill mentioned we don't know when this is going to end, and that is absolutely true. I can tell you this for certain, it will go through at least the end of 2025. So if you have clients, you got business that might be out there saying, hey, I think we should do this. Now is the time to have that conversation. Now is the time to get that just submitted, right? It might take a little while to go through underwriting, but now you know you are doing the best thing for your client saying, hey, I might be able to get them the healthiest rating they're ever going to be, knowing they're probably realistically just a standard health rating. So it's an incredible program. Now is the time to start getting that business in. So next what I'll talk about, guys, is this is a big question that we get a lot is, hey, I see this illustration, it looks great. What is the likelihood I'm actually going to get this rate of return that you are showing me? And we can all say with certainty, the answer is you're not going to get a 6% rate of return each and every year. We can all agree on that. It's not going to happen, right? You're going to have great years. You might have a 0, 1, or 2, or 3% year. But this is at least giving you guys the confidence when a client asks you, how likely is it? You can say, well, since 2006, Allianz's in-force block of business has averaged 6.4%. That's extremely powerful, right? We've had some wicked rides within the market, and knowing Allianz's in-force block has done an average of 6.4% is very strong. That gives your clients the comfort knowing, hey, I'm looking at their track record and it looks pretty good. And this is great, right? But Allianz is sticking with their upgrade program. They said, this is nice, but what if there's a way to upgrade this? And in 2019, Allianz rolled out their index lock. This gives your clients the control and ability at any point in time to capture profits as they see fit. So for example, you have a client, policy goes in force today. 6 months from now, they log online, they take a look, hey, how is this performing? I was illustrated 6%. How am I doing in real time? If they're at, let's just say they're at a 10% rate of return, they can actually lock that 10% in for the year. They don't have to worry about the next 6 months, right? If the world crumbles, we go to World War III, rates increase, all this stuff, they get that 10% for the year no matter what happens. So think about that. You are literally giving your clients the control to capture profits at any point in time during their crediting period. All they have to do is click a button or make a phone call. Now, sticking with that upgrade, Allianz said, well, that's great, but then either you, the agent, or the client have to kind of monitor the index. How is it doing? How is it performing? We want to make sure we capture it. Allianz said, what if they could, quote, set it and forget it? What if they could set an upper target threshold number? And if that index gets there, boom, automatically locks in for them. And we rolled that out a couple years ago. So now your clients can literally say, hey, if this gets to 12, I just want it to auto lock for me. I don't want to have to worry about it. I don't want to track it. Now they can. But Allianz took that even a step further, guys. And I love this new feature that we just brought out, because the biggest question we get, as you could probably imagine, what your client's going to ask you as well, what should I set that target at? Should it be 10? Should it be 12? Should it be 15? And the answer is we don't know, right? Obviously, yeah, 10's great. Obviously, if you go to 10 and you missed out on 2%, that sucks. So Allianz has now a lower target lock. And what I mean by that is now you can start to increase your floor as that index starts to increase. So it's almost like you can chase up your gains. So for example, if you have a client, policy goes in force 6 months from now, they log online, they're at a 10% rate of return, which is great. They can now go in and say, hey, if this thing drops to 8, I want it to auto lock. So now they are protecting themselves on the downside. So now I can go and put an 8. They log on in 3 months, and instead of 15, they can go, all right, I'm going to increase my floor from 8 to 12. Now they know worst case scenario, they're going to get a 12% rate of return. And at the end of the year, if that market continues to take off, they can just ride the wave all the way up, knowing they are protected on the downside. And I've seen plenty of people do this where they say, hey, I'm going to set a target threshold, where I'm going to go, I got 8 on the bottom and 15 on the top, and now I know that is my range of what I'm going to get as a rate of return. It's very powerful, and there's no charge to have this feature available. So you saw that slide I sent, right, where average rate of return of our in-force block is 6.4%. Since 2019, we rolled out the rate lock feature on over 30,000 policies that have taken advantage of the rate lock. The average locked-in rate is just under 10%. So you can see the power of what this thing can do. But what I like about this slide, guys, is look at what's to the right of 10%. You got 12s, you got 14s, you got 16s, you got 18s. The highest ever recorded lock was 24.52%. You're illustrating 6, someone just locked in at 24%. Now, what you might be saying is, well, that's great, but they probably got capped out at 10 or 12%. The answer is no, they did not. These are uncapped. When you see a 24% rate lock, that client on their annual statement sees 24% being added to their cash value. And each and every year that feature is available to them. You got the risk class upgrade, you got the rate lock. Now, Allianz rolled out a new product at the end of last year. And with that, we came out with some new indexes as well. What I love about this slide, guys, if you look at this slide, you say, all right, here's all the indexes that Allianz offers. Obviously, it's a lot. I don't expect you just to sit here and memorize this. What I like to point out is if you scroll down to about the 5th one down under index name, you see lockable. Are these indexes lockable? And you see a lot of yeses on there. S&P futures, is that lockable? Yes. Our blended index, is that lockable? Yes. Our Bloomberg and our PIMCO volatility controlled indexes, is that lockable? Yes. So the name of the game is when it comes to Allianz, guys, the indexes are lockable. Your client has that feature available to them. The only one that we don't have it in is our capped S&P. The big question we get is, okay, I'm seeing an S&P with a cap and I'm seeing an S&P 500 futures index. What do we got going on here? What are those two things? S&P, we all know what that is with the cap. This year, or last year, excuse me, we rolled out this S&P futures index. This is an S&P that comes with a par rate, but it is uncapped on the upside. So now you have an S&P index that is uncapped and lockable. So one of the biggest things you guys are going to hear when it comes to, these vehicles is, well, yeah, these are great, but the indexes have caps on them, right? The S&P is nice, but it's got a cap of 10%. And we all know when it comes to the S&P, it's not going to do, I think over the last 100 years, it's averaged about 9% rate of return. We all know it doesn't do 9% every year, right? It might be up 30, down 20, up 40, down 10. But the biggest thing, guys, when it comes to these IULs is when the equity markets take off and you see those 30 or 40% years, you need to ride that wave with it and not get stopped out at 10%. So with this S&P futures index, you are right there for the whole ride. You are not getting capped out at 10 or 12. You're right there. If the S&P is up 30, you'll be right there with it. So big question we get is, well, how does this compare? How do these two S&P indexes compare? As you can see right here, guys, they're hand in hand. Very powerful, right? And the nice thing with this S&P that's uncapped, on those years like 2003 or 2013 or 2019 or 2021, look at that rate of return that your client is seeing on their annual statement. You think they're not going to call you when they see that and go, are you kidding me? Thank you for putting me in this. Thank you for giving me another lever to pull on in my retirement portfolio. My other buddies that have these got capped out at 10 or 12, and I got a 26% rate of return. Thank you. And it's powerful. And what I'll say too, guys, is of all these indexes you see on the screen, every single year, you get to sit down with your client and say, hey, how do you feel about the markets going into the year? Oh, I'm bullish. Perfect. We got an uncapped S&P. We have a capped S&P. We got some awesome options to take advantage of that mindset. Oh, I'm pretty bearish. I'm a little worried. There's a lot going on. Who knows what's going to happen with politics and all that stuff. No problem. Let's put a percentage into the fixed account. Right now it's paying 5.4%. So every year you get to have those conversations. You get to have your client with confidence tell you how they feel and then make their portfolio exactly how they feel. Tailor it to what they want. And no, hey, guess what? At the end of the day, these are also conservative because you have a 0% floor. Or for some of these indexes, they're actually a positive 1% floor. Plus you have a rate lock, and we can actually start to increase our floor as the index starts to perform well. So I'm going to pause there just for a sec. I know that was a lot. I just wanted to highlight just what makes our product unique. These are kind of the big things, guys, that more and more people are starting to say, hey, I want some of this. I love what this is. I love that upgrade program. I love having the ability to lock it in as much as I want. Because the nice thing, guys, working with Levinson, is every month they get a report stating, hey, here are all the policies that are at or above X%, which those are incredible phone calls for you to make to your clients. Hey, just want to let you know that Allianz IUL that we took out, you're at about a 9% rate of return. You got 3 months till your anniversary. You could actually capture that 9% for the year and not worry about the next 3 months. That's amazing. That is power. Because if y'all remember in 2018, the markets went up literally Q1, Q2, Q3. Q4 came around, what happened? Literally nosedived. People that were expecting 10s and 12s and 15s and 18s got zeros or ones or twos. Having that ability to capture those profits is incredible. And at no extra charge. So you might be saying, well, how is there no extra fee? How can they do that? Great question. Allianz does all of their hedging for their annuities and their life insurance in-house. We don't have a third party doing it. We do it all in-house. And with that, over the last decade, we have saved over $2 billion with a B dollars. That gives us the ability to offer things like the rate lock, because when someone says lock it in, we don't have to wait till the third Friday of the month or whatever it may be to sell that option. We can do it right there on the spot. And that gives us that ability to be able to do things like that. So that being said, guys, let's get into some of the case studies here. I want to talk about 3 different clients. This is kind of what I've been seeing come across the desk more designs, more of what people are starting to request to see. And I want to just touch on how we're doing it, what are we running, showing the power of what this thing can do. But more importantly, guys, it's taking this and saying, okay, of these 3, you might go, hey, I have a perfect client that might fit into this exact thing right here. So with that, I want to get into the first one. We got a 45-year-old small business owner. I would say we're seeing more and more small business owners start to utilize the IUL chassis. More and more people, right? They're coming to you, they're saying, hey, I need some death benefit protection first and foremost, right? But they're looking for some tax advantages. They're looking for some unique ways of, hey, I have cash, my business is doing well. I'm hitting my 401ks or my IRAs or my SEPs, whatever it may be. And they're saying, I need something else. I need some outside the box thinking. What do you got for me? And this is exactly what we're starting to see more and more people say, hey, this IUL is actually incredible. So this example, guys, we have a 45-year-old. He's looking for those 3 things that you see there on the screen that say the goals, right? They want death benefits, some tax advantages, and they want to supplement their retirement income if they can. And you say, great. And what I'm going to tell you guys too, within these designs, we are not telling you to go out there and sell a bunch of assets to get a bunch of money so you can pay premiums. The numbers I'm going to show you guys are not crazy. We're not talking humongous numbers. So in this example, we're going to do $25,000 a year, right? That's it. We're going to do a 20 pay. So on a 45-year-old, we're going to do $25,000 a year to age 65. Then I want to show loans, right? Because he wants that supplemental retirement income starting at age 66 for 30 years. I'm going to run this at an extremely conservative 6%. Right now, you guys know our average in force is done 6.4, and our rate lock average is about 9.8. So I'm keeping this kind of toned down a little bit just so you guys can kind of get more confidence saying, hey, you don't have to show crazy rates of returns or crazy premiums for these things to really hum. So what does it look like? So he might come to you and say, well, I've heard of other companies doing like, bonuses or annual cash bonuses and all that kind of stuff. And you can say, yeah, people can do that. You can, especially if this is like a key employee, right? Like if this is for a key employee, you can say, yeah, you can do that. And they could take their annual bonus and do what? Take it and say, thank you, and go right across the street and go work for the competitor. With these strategies, right, you kind of got these, the golden handcuff concept of saying, hey, you got to let these things kind of build up. Right, you got about a 10-year runway to let this thing kind of build up, and then they can really kind of utilize what this thing can actually do. And then they start to say, okay, that makes a lot of sense. So I've also seen this, guys, not just used for the the business owner itself, but also the business owner says, hey, I want to put some of these on my key employees. I want to keep them around. I want them to know that I'm thinking about them, but I'm doing it in a way where they can't just take a big sum money and then just go across the street and join a competitor. So in this example, like we talked about, right? We got that 20 pay, $25,000 a year. That's it. So he makes that first premium payment in that first year and dies the next day. You just turn $25,000 into $357,000 tax-free. Because at the end of the day, right, this is a life insurance product, right? That obviously, we love it when it's utilized not just for the death benefit piece, because some of the, what's inside of this thing under the hood is literally designed to pull money out. But there is a death benefit piece to all of these. So if that happens, God forbid, you just turn 25,000 to 357,000. That's incredible. And if he makes that last premium payment and gets, and dies the next day, 1.2 million tax-free. But let's say, God forbid, nothing bad happens and this thing actually goes as planned and we want to start pulling money out, as we said, at age 66. He's pulling out over $81,000 starting at age 66. And we did that for a 30 pay. Now, if you toned it down, maybe a 20 pay, that might even increase, right? That money might get higher. But think about that. On a $25,000 a year investment, you're able to pull out 81 grand tax-free, and you still have a death benefit piece tied to it. But the biggest thing, guys, what I keep saying is it's tax-free. You put in all this money, you let this thing grow, and you pull it out, and you're not going to get, at the end of the year, a big 1099. That's power. That's important. Because I think we all can agree where our tax is going. I don't think they're going down. The way we're spending money, it doesn't make any sense how it could go down. You just don't know. But knowing you are putting them in a vehicle that has a death benefit piece tied to it. You're taking care of their beneficiaries, their loved ones. Or you're also able to pull money out of this thing. You're able to use this as collateral against other things, all with one vehicle. And we're not, like I mentioned, guys, you are not going to your clients and saying, hey, you need to take out a second mortgage so we can fund this thing. I need you to sell a couple of these assets so we can really fund this thing. You're saying, hey, we're talking $25,000 a year. A lot of people are going to go, no problem. We can do that. That's easy. And so if this thing all goes according to plan, assuming a death at age 85, look at what you did for your client, all by just coming up with a different strategy. Death benefit, $669,000 tax-free to their loved ones. But look at the amount of money he pulled out in that retirement phase from 66 to 85, over $1.6 million. Think about that. All because you said, hey, let's do $25,000 a year for 20 years. That's it. If you add it all up, over $2.3 million on a $500,000 investment, tax-free. Now, if you guys want more information, you're like, hey, I have clients, I need to do deeper dives on this, talk to Levinson. We will get a conference call set up. We can get into the weeds on these exact strategies. If you have someone that you're like, hey, I know my book of business, I have 3 clients, I need to talk to about this right now, talk to Levinson. We will get a conference call set up literally as soon as you want to do it. Now, the next one, this one is, I would say, kind of near and dear to my heart a little bit. I got 2 young kids, and this is something that actually my parents have started talking to us about. And we're seeing more of these types of strategies, I would say, really come across more and more. This one has been extremely popular. And so you got kind of 3 goals here, right? We're talking about, intergenerational planning. You got grandparents. They want to, hey, I want a supplement call. I want to help out our grandkids, but I would love to be able to do some things for our kids as well. And so in this example, guys, I want you to look at it from this point of view of saying, Mike and Sandy are your clients. They are your clients. You have set them up. You have done things exactly the way you wanted to do it, and they are set for retirement, and they can't be happier. Now they come to you and say, hey, we do have some money that we can play with. We're all set. We're good to go. We know exactly what we can and can't do. But we do have some money that we, want to do something for our daughter and our granddaughter. And you say, great. And most people would say, great, let's do a 529 plan, and that would be it. Right? That's it. Great, do a 529. They'll say, sweet. And it will probably work out just fine. Absolutely, it probably would. But when you go to a party, or Mike and Sandy are at a function, and they go, hey, what are you doing for your kids and grandkids? And that whole thing comes up, and 9 times out of 10 people probably say, oh yeah, we're doing a 529, that's it. And then it goes on to something else. With this strategy, guys, I'm telling you, you do something like this, for Mike and Sandy, who are your clients, that conversation changes and more people are going to start to say, hey, Mike, Sandy, I want to hear more about what your financial advisor did for you, for your daughter, and for your granddaughter. Because I've heard of 529, that's great, but what you are telling me that you're doing is incredible. And what you're starting to do, guys, is create multi-generational clients. Because Mike and Sandy are your clients currently. But when you do something like what I'm about to show you, now their daughter and husband say, well, I mean, what you did for my parents is incredible. I want to do the same thing for my kids. I need you to help me and show me how to do that. Now you just locked in another client. And then when their granddaughter or their daughter gets older, guess what? Guess who they're going to talk to? Because you weren't just the person that said, hey, do a 529. So this example, they told you what you want to do. You say, great, we're going to gift 30,000, so 15,000 each to your daughter, Jessica. She will be the owner and the insured. Obviously, she will pay the premiums. Now we know that the granddaughter Emma is protected. And Jessica now has this incredible policy that you gave them because you came up with a different strategy. So in this example, what we're going to do, guys, she's 36. We're going to do a 17 pay, 30,000 bucks a year. That's what's being gifted, right? 15 each from each parent. I'm going to run this at 5.5%. So I'm going to get even more conservative, right? You know our average is 6.4, average locked in is 9.8. I'm going to even go a step further down and say we're going to do 5.5. And I'm going to run this at standard, right? So everything you guys are seeing, I'm not sitting here running at, preferred plus, even though we do have that awesome risk class upgrade. I want you guys to kind of see, hey, this isn't just all, fake. I mean, this is 5.5% at a standard risk class. That is realistic. I'm not sitting here fluffing this thing up, showing 9% rate of return at preferred plus. So $30,000 a year for 17 years. What does this look like? So let's fast forward. It's time for Emma to go to college. You go, great. We're going to take out a loan for $200,000 and pay for school. Done. Jessica says, thank you, mom and dad. Right, your clients, if they're still around, they're going to say thank you. Otherwise, Jessica, your new client now is going to say thank you so much for doing what you did and coming up with this strategy. Fast forward 5 years later. Same policy, no premiums. Remember, we stopped paying premiums at year 17. So you paid for college. First and foremost, that was the goal. Check that box. Awesome. 5 years later, Jessica and Todd are going, well, we should pay off our mortgage. I mean, that'd be sweet not to have that thing over our heads. Same policy, no extra premiums. They take out another loan for $200,000, pay off their mortgage. Thank you, mom and dad. Thank you, financial advisor. We just paid for our daughter's school and we just paid off our mortgage. This is incredible. 6 years later, Jessica and Todd are like, well, man, we'd be fun to, kind of retire and kind of have our own schedule and go see, our daughter more and, all that kind of stuff. So they say, well, let's turn on the income stream on this thing. No extra premium still. They've already paid for school and they paid off their mortgage. Now they turn on an income stream for the next 20 years of over $120,000. Think about that. You paid for school, paid off a mortgage, and now you're helping them supplement their retirement income with over $120,000, all because you had an idea of not just doing a 529 plan. Fast forward, when Jessica passes away, she leaves her daughter over $1.3 million. We all want to leave a legacy, right, to our kids, right? We all want to leave them something. Jessica was able to do that all because you had an idea of gifting 30,000 bucks a year for 17 years. She was able to leave her daughter something that a 529 plan would never have been able to do. And those are the strategies, guys, it's winning business. Not only that, it's taking a step further where people are now they're giving out referrals. They are saying, look at what my financial advisor did. He or she was not just the person that said do a 529, because that's easy. And it would work. It would absolutely work and pay for school and do exactly what it's supposed to do. I'm not sitting there bashing them for a second. I'm saying there are ways to be creative. There are ways to think outside the box, and there are ways to create the power of your client saying, this guy or girl went above and beyond for me and did not just paid for school, paid for our daughter's mortgage and supplemental retirement and left a legacy to our granddaughter. All on $30,000 a year. So I mean, this is kind of right. Let me look at the summary of what this thing can actually do. On $510,000 investment, you were able to turn that into almost $4.2 million tax-free. That is power. That is thinking outside the box. That is taking things a step further and really leaving a legacy. And same thing, guys. You have clients, which I mean, I've talked to plenty of advisors that have seen this strategy and they go, my goodness, my book of business, this is perfect. There you go. I got a bunch of, retirees literally, and they go, this is exactly what they're looking for. This is exactly what they want to do. They can easily give $30,000 a year. That's nothing to them. And they can do something like this. I mean, I've seen it. I've seen advisors' eyes literally light up when I've talked to them about this strategy. They just go, this is incredible. I got 15 people I need to call. And when you can tell your clients, we're talking about $30,000 a year, they're gonna go, that's it? Really? You can do all this? I'm telling you guys, now is the time to review that book of business with that risk class upgrade, the rate lock feature. Now is a phenomenal time to just do those reviews. Hey, this client, this might be worth just having that conversation. Because when you present to them an idea that is outside the box, your clients start to go, wow, they're really thinking about me and what's best for me and my family. That's awesome. So lastly, guys, I'll wrap it up. Like I said, I want to respect everybody's time. I know that Bill's got to get back on and do some stuff at the end. Hey, Bill, if I can win those AirPods, let me know. It'd be sweet. The last one I get, this is a big question we get, because right now I've shown you what? I showed you a 45-year-old and I showed you a 36-year-old. So you're probably going, well, crap, I don't have 45-year-old in my book of business. I mean, I have a couple, but not a ton. I got a bunch of maybe older clients. No problem. No problem at all. That's a big thing we get is, what about people in their 60s, right? Or over 50s? What about them? I think this kind of slide resonates with a lot of people, right? I know I have quite a bit of my, I got a 401k and that kind of stuff, and that's where a lot of my stuff is. But I have, I've got the IULs for my daughters. I got one on my wife. I got one on myself, right? It's starting to be like, hey, there are other vehicles out there that it's just nice knowing you have different levers to pull on. And it even works, guys, on a 60-year-old. So we got a pre-retiree. They come to you. They're like, hey, yeah, I need some death benefit for protection, but I also, I want a little more tax-efficient portfolio. And you say, great, I have the perfect product for you. It's an IUL. And they might say, well, I've heard that doesn't really work with people that are, my age. And you say, well, let me show you. So this example, guys, we're going to do a 60-year-old. I'm going to run this at standard again on a 60-year-old. Now remember, if they came back at a table 2, their risk class would be what? Preferred best. That is correct. They're a smoker, comes back standard tobacco, that's getting issued at preferred tobacco. So in this plan, we're gonna do $100,000 a year for 5 years. So we're gonna do a 5-pay. You want a death benefit, that was the first thing he said to you, but he also wanted a tax efficient portfolio. So you say, great, let's see what this thing can do. Well, right away, if he makes that first premium payment to you, $100,000, you just turn that into $1 million. God forbid something happened to him. You check that box right away, right? He wanted death benefit, you're giving him, right, 10x on his initial premium. So let's fast forward. You want a tax efficient portfolio, which means you wanted some distributions. So in this example, as you can see here, guys, this is on a 60-year-old, so it does work. You put in $500,000 total. God forbid something happened to him after he made that final premium payment, $1.3 million. You did exactly what he asked. I want death benefit protection. You got it. But he also wanted a tax efficient portfolio. He wanted to be able to enjoy his retirement. He wanted to pull money out of this thing outside of just 401ks and IRAs and that kind of stuff. He wanted something else. You say, great. He pulled out over $1.1 million, guys. Think about that. 1.1 million. And at 95, if he passed away, still $300,000 there. You turn a $500,000 investment almost into 1.5 million. Tax free. That's the most important thing. All these numbers I'm showing you, everything you've seen so far with all these examples, that's all tax free. Your clients aren't getting 1099s. They're not getting anything from Uncle Sam. They're not coming after any of this money. This is all tax-free money. That's huge. And it's just a unique strategy, guys, just a different way of thinking. It's a different idea to present to your clients, or they just might say, wow, that's pretty cool. And I don't have to do, I don't have to sell a bunch of assets. I don't have to come up with all this money. I don't have to feel like I'm getting squeezed. And now I have another lever that I can access to do all kinds of things. I've seen these things used, guys, where people literally have put these up as collateral to get an interest rate on a mortgage or, construction loan, wherever it may be, because banks love these. And why is that? Because the cash value in there is protected on the downside. They got 0 or 1% floor. So they know in the market, if you show your 401k, they're like, well, yeah, that's great, but if the market drops 40%, that thing's getting cut in half. Oh, but this IUL you're showing here that's got $500,000 of cash value, that's protected on the downside. That's amazing. So these are utilized in so many different ways. So powerful. So I'd highly, highly recommend, guys, now is that time just to literally sit down with your clients as you're coming into the end of 2025 and you're gearing up for 2026. Now's the time, because these products have never been better. They're easy, they're clean. And now is the time just to have that conversation with your clients and just say, hey, look, this might be a strategy we should implement. We're not going to reinvent the wheel. We're not going to make you sell a bunch of assets. We're going to put in some money that you can afford. And now you have a whole different lever that you can access to do a whole kinds of different things. Same thing, guys. If you have someone like this, like, hey, I gotta talk to someone, reach out, right? Talk to Andrew, talk to Bill, get on the phone with them. We can set up any time you want to get into advanced markets, whatever it may be. Levinson can get you guys set up for that. So I'll just recap real quick. We got 3 case studies, right? You got a small business owner, right? 45-year-old, you saw the power of what that can do. And more people are utilizing this. They're also using it as key employee, right? Because employees love being like, hey, this guy's going to put this on me. This is phenomenal. This is great. And I know in 10 years working at this company, I'm going to have this thing left over when I leave. That's incredible. You saw the power of that intergenerational planning. And I like to more say it's intergenerational, clients is the way I kind of look at it, right? You are building clients for generations. Because I've seen stories, guys, where people do something like this, and then when the grandparents pass away, there's a notebook, and all it says is call XYZ financial advisor, they'll get you taken care of. That's incredible. And that leaves a legacy. And then lastly, you saw a pre-retiree, right? You saw it on a 60-year-old. So you've seen it with an array of ages. It works. It's just all about the design, which we're going to, Bill mentioned, we're going to be that in-person event. We'll get into more hands-on, right? If you have a client, you're like, hey, I want to see this run real time, we can do that. This will be a little more hands-on. We can pull up the illustration software. We can kind of run this thing, how we want to see fit, but you guys can see some real world examples, real time. How does this perform? How does this look doing X, Y, Z? So that'll be awesome. I believe that's October 2nd, Bill, correct me if I'm wrong. Plus you're going to get some CE credits, right? I mean, it's kind of a win-win. Plus you get a free breakfast. I mean, come on. Who doesn't love a free breakfast, right?
That's right.
But with that,
right.
guys,
We even got good stuff, Eric. Yeah, we even got the fruit platter is what I was going to say. So you can't miss it. October 2nd.
You even got the fruit platter. So with that, guys, I'll pass it back to Bill, but I want to say thank you. I really appreciate the time. I can't stress it enough. Seriously, review that book of business, make that phone call. You just never know what can happen if you just bring up this unique strategy. And it could just lead to not only just, your clients saying thank you, but new clients coming to the board and saying, hey, I saw what you did for them. I want that too. But with that, I'll pass back to you, Bill. I appreciate it. I'll hop off so you guys can kind of do your thing, and we'll talk soon.
Good stuff.